Welcome to another explainer. Let's just jump right into it. Today, we're taking a really close look at a highly sensitive and honestly often misunderstood topic: racial bias in mortgage lending. We're unpacking a fascinating 2022 working paper from researchers over at the Federal Reserve Board to answer a hotly debated question. Are banks actively discriminating against minority applicants today, or is there a deeper mathematical reality hiding in the financial data? Now, for a long time, we've known that minority homebuyers face way higher hurdles when trying to get a mortgage, but the exact reasons why, that's been fiercely debated. So, using this newly available, highly confidential dataset covering literally nearly 15 million mortgage applications, these researchers set out to find the truth. Let's let the data tell the story here. Right out of the gate, the raw data presents a pretty stark reality. In 2018 and 2019, Black applicants were denied mortgages at a 17% rate. Compare that to just an 8% denial rate for white applicants. And Hispanic applicants, they faced a disproportionate 12% denial rate. Just on the surface, that is a massive gap. We're talking about Black applicants being essentially more than twice as likely to be rejected when trying to buy a home or refinance. So when you see a gap that wide in something as absolutely crucial to wealth building as homeownership, you immediately have to ask, what is actually driving this disparity? Is it human prejudice? Are loan officers treating minority applicants differently just based on race? Or are there underlying financial risk factors that we need to uncover to really understand the whole picture? To start peeling back the layers on this, researchers didn't actually look at human decisions first. Instead, they looked at automated underwriting systems, or AUS for short. Think of these as strictly colorblind government algorithms used for loans backed by places like Fannie Mae, Freddie Mac, or the FHA. By law, these systems don't know your race, your ethnicity, or even your zip code. They establish a purely mathematical baseline for approval based on statistical risk models. So right off the bat, they strip human bias entirely out of step one. But here's the thing. Before a human underwriter ever makes a call, there are massive differences in observable financial health. Thanks to some expanded data reporting rules, researchers got to see exactly what these algorithms see. And the data shows a huge 40-point gap in average credit scores between Black and white applicants. We're looking at 685 versus 726. Black applicants also averaged lower incomes, higher loan-to-value ratios, which basically means smaller down payments compared to the home's price, and higher debt compared to their income. And these are the fundamental bedrock metrics of mortgage lending. Now watch what happens when we factor those metrics in. That raw denial gap of 9 percentage points, it starts to plummet. When the researchers simply control for whether that race-neutral algorithm recommended approval, the gap literally drops by more than half, down to 4.3 points. And then, when they factor in the exact credit scores, down payments, and debt ratios, the gap shrinks down to just 2 percentage points. It's wild how much the math explains right away. But to explain that final stubborn 2-point difference, we have to understand something the mortgage industry calls overlays. Overlays are basically additional, stricter underwriting rules that individual lenders slap on top of the government algorithms. Even if the government says, hey, this loan is fine to approve, a bank might add extra safety margins to protect themselves from litigation or default risk. They might say, well, the algorithm accepts a 620 credit score, but for us to fund it, our bank requires a 640. And that brings us to the crucial remaining 1 to 2 percentage point difference, which the researchers categorize as excess denials. This basically means that after controlling for the algorithm and all the major financial metrics we can see on paper, Black and Hispanic applicants are still 1 to 2% more likely to be denied than white applicants with the exact same profile. So you gotta wonder, is this final gap where the illegal discrimination is hiding? Well, when analyzing these excess denials across the whole credit score spectrum, a really fascinating pattern pops up. The excess denials for Black applicants spike dramatically at the lower end of the FICO score spectrum, specifically right around that 600 to 650 range. Interestingly enough, both the strict human lenders and the race-neutral government algorithm completely agree here. This lower credit group carries way more risk than what their baseline numbers might show on the surface. So, what does this actually mean? It suggests lenders are looking at unobservable risk factors. These are details missing from the raw demographic data the researchers had, but they're things a lender absolutely checks. We're talking about exactly how much cash you have saved up in the bank, how long you've held your current job, or your ability to perfectly document your income history. Applicants with lower credit scores often have thinner cushions in these exact areas, and when lenders apply their strict overlays, these are the folks who fall short.
Now, you might be sitting there wondering, are these overlays just arbitrary roadblocks designed to keep certain people out? Well, the data actually proves otherwise. By looking at how the loans performed after they were issued, researchers found that lenders who impose the toughest overlays end up with significantly better performing loans. We're talking fewer defaults across the board. So these strict rules aren't necessarily about prejudice. They're a justified business necessity that accurately reduces risk, even if they disproportionately impact folks with thinner financial reserves.
But look, the researchers didn't just stop at the financial explanations. To be absolutely 100% thorough, they actively hunted for human bias. They looked at environments where discrimination could theoretically run rampant. They looked at fintech lenders, where there's literally no human loan officer to look you in the eye. They looked at highly concentrated markets with low competition, where lenders could theoretically afford to turn away good business just out of prejudice. They even looked at areas with high racial animus, based on localized Google search data.
And the results here are honestly incredible. None of these environments correlated with higher excess denial rates for minority applicants. In fact, excess denials were actually slightly higher at the completely automated fintech lenders, which is the exact opposite of what you'd expect if human prejudice was the driving force, right? And in areas with high racial animus, even the colorblind algorithms denied applicants at higher rates. That suggests the underlying financial risk was simply higher in those areas, rather than it being localized human discrimination. So, letting the data tell the story, the researchers came to a pretty definitive conclusion. They state, overall, we find that differential treatment has played a limited role in generating denial disparities in recent years. This marks a monumental shift, guys. Back in a landmark 1996 study, unexplained excess denials hovered around 8 percentage points. Today, thanks to automated underwriting and basically 30 years of fair lending enforcement, overt differential treatment by lenders has practically vanished. Which leaves us with a profound realization. If active lender discrimination isn't the main driver of that massive 17% to 8% denial gap we saw at the very beginning, how do we actually fix it? To truly close this divide, our whole focus needs to shift. Instead of just auditing lenders for a bias that the data shows is largely absent, shouldn't our policies pivot toward fixing systemic credit score and wealth disparities? The system isn't necessarily prejudiced, it's just reflecting the financial inequalities that already exist out there. So the question we have to ask ourselves now is, how do we finally change that underlying reality?